Gerard, the IMF says that the global economy is going to grow only at 1.3% for much of this year. What is your take on that, and what do you think the mechanics of that growth will look like?
Well, the financial crisis has become a world recession, and all economies are being hit hard. Some obviously harder than others. So the world economy will contract this year. But the important thing is that recessions do end. In fact, often recessions end after 1 year. Most of them end certainly after 2 years. And this recession has already been going on for some considerable time, with the US, for instance, going into recession at the end of 2007. In my view, and our view at Standard Chartered, we think the US and the UK economies will hit bottom at the end of this year. The European and Japanese economies will hit bottom towards the start of next year. But very importantly, across the emerging world, there's already evidence that some economies have turned the corner. China has turned the corner and is now already picking up. India is already picking up. Indonesia looks quite resilient. And when one looks across the emerging world, it is necessary to differentiate. Central and Eastern Europe faces a greater challenge. Parts of Latin America are in difficulty, but Brazil looks like it's also past the worst and will probably have neutral growth this year. And then parts of Africa didn't do as well on the way up, will not do as badly on the way down. But the regions that probably will shine will be the Middle East and large parts of Asia. Now, when one looks at Asia, it's important to stress that the Asian exporters will be in recession this year, but they will start to turn the corner towards the end of this year, with year-on-year rates of growth then starting to pick up. So when one looks across the world, it is necessary to differentiate. The West will come out of recession in the US towards the end of this year, but I think it's very important to stress that the likes of China, Indonesia, India are already experiencing steady growth, and the Middle East with its current account surplus and Asia with its current account surplus should start to grow at much healthier rates as we go into next year.
How do we read what's going on today? If we take, all of us wish that we could read the development of the economies in a linear fashion.
Well, the outcome of this crisis will depend on the same factors that, quite frankly, determine the outcome of every crisis. And indeed, previous crises have been smaller, but nonetheless, their outcome, like this one, will depend on the same three key factors: the economic fundamentals, the policy response, and confidence. As I was just touching on, the fundamentals do vary across the globe. The policy response, interestingly, has been very global in the sense that around the world, policymakers have responded in much the same way, and it's been an impressive policy response. Monetary policy, fiscal policy, and targeted measures, whether to help the financial sector or indeed to help other areas of industry. But the key factor that's always impossible, sometimes very difficult to call, is confidence. And when confidence is hit, it really is hit hard. But when confidence recovers, it sometimes can recover far quicker than anyone anticipates. And what we've seen in recent weeks and recent months is a return of confidence to the financial markets. I think that return of confidence is fully justified. It reflects the fact that only a few months ago the markets were, wrongly in my view, fearing a depression. Markets were then pricing in tremendously bad news. We've seen markets realise that a depression is not likely. They've started to therefore factor in a recovery and a mild pickup of inflation. But in addition to that, very importantly, the markets also anticipate a continued period of relatively low policy rates. And that's helping drive the confidence in the financial markets. Now, the big question is, of course, whether that translates into a pickup in confidence in the real economy. If it does, then maybe this rally in the financial markets will continue. If it doesn't, that is, it doesn't translate into an improvement in economic confidence.
In terms of the pickup in the real economy, now that's where the real story is, because the real economy is very different. If you talk about China, if you talk about other parts of emerging Asia, and other parts of the emerging economies. I mean, the Middle East is somewhat differently driven than Southeast Asia, for example. Yeah. So what are the components of the real economy, and how do you sort of divide up the world in terms of what you want to see on the real economy front?
Well, all of these regions face not only near-term challenges, but also longer-term issues. But when we look at the challenges and the issues, if they're addressed appropriately, then suddenly the issues and challenges become great opportunities. This is very true in the Middle East. If one goes to the West, one often only reads about Dubai's property market, but the reality is the Middle East has actually seen many positive factors. If one goes to Qatar or Saudi Arabia, the infrastructure boom continues. The way I describe the Middle East is to think of the 3 Ds: demographics, diversification, the dollar. The Middle East has a very young population. Therefore, the Middle East needs to diversify away from energy, which is very capital intensive, to creating a more diversified economic structure where there basically can be jobs generated for the people.
But that's in a way where they went wrong, because they were in the process of diversifying, they were in the process of creating depth into their economy.
Well, I think the other D is very important, the dollar, because in the last few years, the Middle East did not have the appropriate domestic monetary policy because it tied itself to the US. And by tying itself to the dollar, it tied itself to US interest rates. In recent years, US rates were far too low for what the Middle East needed. The Middle East needed much higher levels of interest rates to actually cap domestic asset price inflation. Obviously, at the moment, because we're in a global downturn, the Middle East is happy sticking with the dollar. It has a sort of stability about it. It ties the Middle East into low US rates when it now needs them. But at some stage in the future, and your question is right, the Middle East will need an appropriate monetary policy for its own region. But the important point is that whilst that will have to occur at some stage, the important point is to not lose sight of the underlying structural shift. The demographics do determine a diversification of the economy which is positive for the Middle East.
You talk about the 3 Ds, but what about the big O, oil?
Yeah, it's been very volatile recently. A few weeks ago we had the meeting in Vienna where it was quite clear that the OPEC producers would like to have an oil price around $75. And then indeed the market
paid a few bills as a result.
Although it has to be said that when oil prices did go up to $147 a year ago, not everyone in the Middle East spent that money. Yep. They did actually put it away for a rainy day, which has helped the region. Where are oil prices going to go? It's very difficult to say, because even though prices have been volatile recently, even though the region in the Middle East and OPEC wants higher oil prices, there's been a big pickup in inventories. Tankers are full of unsold oil. So that suggests that oil prices could easily fall back. I would suggest that the best way to think about the oil price is that it has a firm floor but a soft ceiling. It has a firm floor because the costs of producing have gone up. There is underlying demand from the likes of China. China has been stockpiling oil and many other commodities in recent months, but the ceiling is soft. I think as we work through this recession into recovery, it's difficult to see oil prices really spiking aggressively higher. But certainly the further ahead one projects, the more likely it is that oil prices will start to trend up.